We're going to start today looking at the pending sales numbers. Last week, NAR reported that existing home sales declined in June to an annual rate of 4.2 million. It's now obvious to everyone that home prices have held up in 2023, really because demand has exceeded the very, very limited supply of homes to buy all year. Everyone now understands that inventory is a limiting factor. The question I've been getting lately, though, is whether we've turned the corner on home sales, the number of transactions. With the total sales rate, will it fall below 4 million? Will it climb closer to 5 million? That's what we're going to look at today in the data. Altos Research tracks every home for sale in the country every week. We analyze all the pricing, the supply and demand, all the changes in that data, and we make it available to you before you see it in the traditional channels. I'm Mike Simonsen. I'm the founder of Altos Research, and let's look at the data from the second half of July 2023. So NAR uses a seasonal adjustment to the data, seasonal annual rates, where at Altos, we simply count everything. So NAR reported a seasonally adjusted annual rate in June of 4.2 million home sales, 4.16 million to be precise. So the question is, will that start to grow? There are now 378,000 single-family homes in contract. There were 68,000 new contracts for those single-family homes this week, 68,000. In this chart, the light portion of the bar is the new contracts each week. In these videos, I tend to focus on single-family houses and don't typically include condos. I like to do that to keep the data clear and consistent week to week. But there were another 15,000 condos and townhomes that went into contract. So the pace of 80 to 90,000 new sales per week translates pretty directly into 4.2 million for the year. When you think about the completed sales, the pendings that we report here are the earliest proxy for the sales that will complete in the future. The homes typically take 30, maybe 45 days in contract. So when NAR reports the June sales data, these were pendings in April and May. So if you want to see where the sales rate will be in the future, keep your eyes on this data set. And I think it's important to note that the pace of new sales is not accelerating. Home buying demand is limited by affordability, of course, but this is a supply-constrained market. So even if demand picks up, the rate of sales is still going to be way under 5 million. The rate isn't accelerating, but the comparison with last year when sales were tanking is now getting easier. So NAR reported that existing home sales rate was 18% lower than last year in June. By our count, that margin has narrowed to 10% now. So the new sales rate, that's the light portion of the bar here, is only 5% fewer than last year. So the pace of the new home sales is holding steady now, while last year it was falling. The comparison gets easier, especially after September. And just to zoom in on the new sales rate for a moment, in this chart is one I haven't shared before. We have the total count of new contracts each week. The taller the bar is, the more sales that are happening. The dark part of the bar are the single-family homes, and the light portion of each bar here are the condos and townhomes. So I included the condos here so you can see the total sales number that I'm referring to. With 80 to 90,000 new contracts starting each week, that translates into 4.2 million for the year. In this chart, you can also see how rapidly the sales rate fell, again, in September of last year, and how steady it's been this year. So while the rate of sales is not really increasing, the comparison with last year will get easier, and 2024 will show an increase likely in the total sales rate, because Q1 of this year was still recovering this year, and then assume it stays recovered, next year, the whole year will have greater sales. The median price of the single-family homes that took offers and went into contract this week was $380,000. That's up a tiny fraction over last week and a little over 1% higher than last year at this time. We can see in this chart how quickly home buyers reacted to the big mortgage rate jumps last year. See the big dips in the light red line in July, and then in September is the big one. This tells us two things. First, if rates jump again, consumers will react. This market recovery is very sensitive, both in price and in sales volume. The second thing we learned is that by September, if mortgage rates don't jump, then the year-over-year home price changes will get much easier. So you can see why home prices will likely end the year up over 2022, unless mortgage rates spike again. I spoke with Robert Dietz, the chief economist for the National Association of Home Builders, last week on the Altos podcast. If you haven't watched the Altos podcast or listened to it, check it out. Top of mind. Robert mentioned that they're still of the view that last November's peak in mortgage rates was the peak. Rates have been between 6 and 7% all year, and the assumption that mortgage rates will come down from here is based on three things. One, that inflation has peaked and will continue to subside. Two, that the economy continues to cool or even goes into recession and the Fed will lower rates. And three, that the spreads between the 10-year bond and the 30-year mortgage rate will start to return back to normal levels. I don't predict mortgage rates, but Robert was very clear in his analysis, and I find that very, very compelling. Listen to that podcast from last week, the Top of Mind podcast, if you want to hear Robert's explanation of how their view of where rates should be expected to go. Okay, there are now 479,000 single-family homes on the market across the U.S. Each year, housing inventory typically peaks in the third quarter, usually the last week of July. If a year is a market slowdown, like 22 or 2018, inventory might not peak until September or October. This year is not a slowdown year. So our estimation is that inventory could peak as early as next week. My guess, though, is that inventory continues to climb into late August, and the curve will look more like 2021 than, say, 2016. The key takeaway on inventory, though, is that there is no signal anywhere in the data of any surge in inventory. We're currently projecting 2023 to end with just over 400,000 single-family homes on the market. When we started the year, our projection was closer to 600,000. That projection calc changes each week as new data comes in, and each surprise lower adjusts the end of the year lower. And we've had basically low inventory surprises almost every week of the year, all year. The median price of single-family homes, of all the single-family homes in the U.S., is $450,000 again this week. That's unchanged from last week and is also unchanged from a year ago. Last year, home prices were coming down pretty quickly. Last year, prices peaked at $459,000 in early July, and home prices did not reach that peak again this year. Just a fraction lower. $450,000 is like a psychological threshold for sellers, so prices tend to cluster around these big numbers. So we could see several more weeks at $450 or maybe $449 before discounting kicks in later in the summer. Home prices should end the year about $410,000, and that's just a percent or two higher than where 2022 ended. The median price of the new listings is $400,000 this week. That's the light red line here. That's down from last week. The price of the new listings is basically unchanged from last year. Again, this is another signal that despite affordability challenges for so much of the country, there are sufficient buyers at these prices and these mortgage rates that home prices are not falling in 2023. In fact, they'll end the year up a little bit over last year. The percentage of homes with price reductions ticked up this week to 33.7%. So a third of the homes on the market have taken a price cut from their original list price. Each line on this chart is a year, and you can see the annual curves the market goes through and how it illustrates when demand is highest, the price reductions are the lowest. I included a few more years in this chart than previously, just to illustrate how solidly normal territory this market is in, balanced between buyers and sellers. The slope of the curve, how steeply it's rising or falling, tells us if the market is shifting. This year, the dark red line, and you can see how the market emerged from that frozen state last fall to balance state it's in right now. The light red line from last year with its big spike and the yellow line from 2020 are the most striking though here. And you can really see how dramatically the market changed in those years. If you study the data closely though, you'll notice that for example, in 2017 and 2019, the market accelerated in the second half of the year, while 2018, it decelerated in the second half of the year. Those were much more subtle shifts, but if you were selling a house in the fall of 2018, you felt it for sure. And so that's what you can see from the price reductions. The trend in price reductions right now is just on the slow side of balanced. We can see that fractionally more price cuts happen when mortgage rates are near 7% than when they're closer to 6. Slightly fewer offers, which means slightly more price cuts for the homes that are on the market. The balance in this data implies that the sales prices for the home sales that happen in August, September, and October will hold up just fine. Again, if buyers are mortgage rate sensitive, so if rates spike, we'll watch the rate of price cuts kick up too. And you can see that spike in the light red line of September last year. Hopefully, Dr. Dietz is correct in his assumption, and rates have seen their highest watermark. So that's the middle of July 2023. This is a national view. If you need to understand your local market and communicate about what's happening in your local market to your buyers and sellers right now, go to altosresearch.com and just book a free consult with our team. We'll help you interpret the crazy data for your clients. We'll look at your local market. It's a critical time to be informed about the market, so please join us.